everyone's saying that they can hear me. Is that correct? Are we all on the same page? Okay. Okay. I'm looking at everybody saying that they can hear me. So I'm going to go back. So we're going to be talking about making your first stock trade. The biggest thing about stock market investing, again, is what's been said, is that nobody really knows. They know it's important, but they don't know how to do it. So I started the IB Investor in 2014 for that purpose, to really break down Wall Street in simple terms, specifically for the African American community, because I've been working in financial services for about 15 years, and every person that I worked with, everyone that I worked with that looked like me just didn't have the basics down at all. And so we spent a lot of time, because, in financial services, if you know anything about the industry, it's highly sales oriented. So you're always talking about sales, always talking about sales, always trying to make a sale. But I didn't feel comfortable, and I wasn't going to feel comfortable having conversations about sales if we're not educated about the basics. And so that was kind of where my disconnect was. So I thought it was super important to have a conversation with people, educate them, and then take them into the sale. But again, that takes a lot of time, and nobody really cares more than you do about your community if you're not turning over the numbers that they would like you to make. So it was an interesting thing for me. So I stepped out of kind of like client-facing sales, and I did retirement service, consumer banking, high net worth advising, and now I'm a tax attorney. And just kind of to talk about my background generally, I started working as a financial advisor in 2003. I was working when Google IPO'd at $100 a share, and we all complained in the office that we thought it was entirely too much per share, and look at it now. So, and actually I started being a financial advisor in 2003, but I didn't start investing in the stock market until 2004, when I actually quit being a financial advisor and I started working at Sam's Club. So I give you that information and that background to say is that we kind of all come to the party with different expectations and different understandings about the market. But even those who are educated, it sometimes takes them some time to get there. So I feel like a lot of people get so upset about everyone gets so upset about not knowing or not knowing enough that they just don't get started. So I wanted to kind of talk to you about that and where I was. My first stock was Walmart. One of the biggest things that I did as an investor is that I wasn't ready to invest. And what I mean by that is that I kind of had like outstanding things going on. My credit wasn't right. I didn't have an emergency fund. There were certain things that I just personally didn't have to make me ready to invest. So I ended up pulling out money out of Walmart. Now, I purchased Walmart stock at $38 a share. That was pretty much what I was purchasing at that time. And if you know anything now, I think it's about $70 a share. So again, when you're not ready to invest, you end up missing out on opportunities. And I've done that a couple of times. And, since I've become an attorney, things are different. But again, and even when I was working for Merrill Lynch, things were different. But when I first started investing, I was 23 years old, and I just didn't quite have all of the tools in my tool shed that I needed to kind of build the investing house. So I just wanted to talk to you about that. Now, generally, let me go back for a second. I provide commentary and webinars about creating wealth through investing, which is pretty much looking at the stock market, using stock market as the primary vehicle. The next thing is I do a little bit of conversation about cryptocurrency because I was interested in it, and then I kind of gotten like on the crypto bus, and like I haven't gotten off yet. I do think it's an excellent thing to kind of be a part of and understand. But also it's kind of a highly speculative investment. So I always suggest that you have kind of like your base investments and you kind of use that as your icing. So you have a good cake going on, you put the icing on the top, and that would be like your cryptocurrency. But then also talking about, also talking about retaining wealth using appropriate tax strategies. I'm going to talk about, as you go through purchasing stock, how that changes, how your tax implications change throughout the whole process. If you're holding a stock and you're getting dividends, you're going to be taxed on your dividends. But if you're selling a stock, you're going to either have capital gains, long-term or short-term. And we're going to talk about them a little bit more but also talking about how do I put myself in the best position where I'm not just giving Uncle Sam away all my money. I'm just not saying, okay, IRS, just take it all. Here's my wallet. Let me dump out my wallet. So I think that's where a lot of people get caught. Also, and then finally, I'm talking about wealth creation, transferring wealth efficiently between generations. One of the things that happen in the African American community a lot is that we end up dying without wills. We end up dying without instructions about what's supposed to do with what our assets are supposed to go or where they're supposed to go. And then you also have assets that go outside of the probate process. So if you have a property that's, if you own it with somebody, joint tenants of rights to survivorship, then that automatically goes to the other person when you pass away. Same thing with stock accounts. Stock accounts have beneficiaries. Retirement accounts have beneficiaries. All of that goes outside of probate. So again, it's knowing what's the best way to go about these things and the best way to transfer wealth so you're not losing money along the way. If you don't have a will, if you don't have something set up, it's very costly to deal with this. And I tell this to people all the time. A pound of prevention is worth an ounce of cure. An ounce of cure is worth a pound of whatever. Y'all understand what I'm saying? Basically, if you take care of it on the front end, you're a lot better off than trying to deal with it on the back end, because once somebody dies, there's a lot of things that you can't do anymore. You're kind of like foreclosed on a lot of action. So I tell people that get it in front of it, take care of it, and then move on. And you can change it. So again, like I said, I mean, I had problems investing early on because I didn't have an emergency fund. I didn't have what I call legacy protection, which is basically insurance. And I didn't have a good debt management plan. So when I say emergency fund, I suggest personally having an emergency fund about $2,000. This is tax season. A lot of people end up getting a lot of money back in tax season and during tax season or as your tax refund. I tell people, just kind of take care of these basic things so you can kind of move on with your financial life. So $1,000 to $2,000 in your emergency fund that you don't touch, you only use it for an emergency. And I usually say about $2,000 because I've had some emergencies that were more than $1,000 but under $2,000. So I tell people that all the time. And what I mean by legacy protection, I mean by insurance. I mean life insurance, and also mean renters and homeowners insurance. A lot of people forget about that. And it's kind of like just protecting the stuff, protecting what you have. You have your life and you also have your stuff. And there's nothing worse than losing your things to a fire, a flood, something like that. And then you basically have to spend all of this money to replace what you already purchased. So you end up kind of coming out, you end up in the hole. And then also talking about debt management. I don't think that in order to jump into, I don't want people to think like, oh, I have to have all my debt paid off. I have to pay all my debt off before I can start investing. No, but I do suggest that you have a plan to pay off your debt or to basically manage and tackle your debt, because that's what happens. What ends up happening is that something happens debt-wise, and then it kind of starts to snowball. So if you have all these things taken care of, you basically have like your stuff protected, you have an emergency fund, you have a debt management plan, then that's when you're ready to get investing. And I know that's not fun. I know it's not sexy. I know it's a lot of people are like, no, I want to invest right now. Well, just wait a second, because in the long run, it ends up working out better if you do it kind of in a way that makes sense for your whole financial portfolio, your whole financial life in another sense. So let's see. So we talked about it on Saturday, and HBC Wall Street, Torrance and Jamaris have talked about 7 streams of income. And there's commentary that says 7 streams of income are, it's basically the average millionaire has 7 streams of income, which, I kind of laugh at that because no one can really give me a source for it. And the only source that I found was in the Bible. And it actually says 7 or 8 in case of problem, in case of peril. But also, if you start looking at the millionaires, the billionaires that we look at and we look up to, they usually made their money in one or 2 sources, streams of income, maybe 1 or 2. Like Warren Buffett, he made the bulk of his money in dividend income and capital gains. If you look at Bill Gates, he made his majority of his income and profit income in terms of selling windows, but also royalties for other companies using his platform. So a lot of times people are like, it's not all 7. Now, do you get all 7 over time? Sure you can. But a lot of people don't make that initial bulk of wealth off of all 7 because it's hard. You know, jack of all trades, master of none. So I just want to talk about briefly what these 7 streams of income and kind of where stocks play into this whole concept. So you have your first baseline of earned income, basically your active income. You go to work, you have some type of thing that you're doing something to get paid. So you're exchanging dollars for hours. That's your earned income. And then you have your profit income when you're actually selling goods and services. That's your profit. Then you have interest income. Think about that as your savings account, which we all know is not a lot. But also if you're doing peer-to-peer lending, that's also going to be interest income. It's usually a kind of a smaller bit of interest income, but that's your interest income. You're basically lending someone money with the expectation that they're going to pay you back what they owe you, and then also give you more money for basically the privilege of using that money for that time period. Then you have dividend income. Dividend income is when you have a company and they're distributing their earnings and their profits to you as a shareholder. That's your dividend income. Then you have your rental income, which is basically you're renting properties and your tenants are paying you for the privilege of living in your property. Then you have your capital gains. So capital gains, you can have it on the stock side and you can have it on the real estate side. And I really like to talk about that. So capital gains is when you're selling a capital asset. A capital asset would be considered real estate, stock. They're all considered by the tax code to be a capital asset. So it's basically you're selling an asset at a gain. So that's your capital gain. You're selling this capital asset, either a stock or real estate, at a gain. So if I purchase a real estate property for $50,000 and I end up selling it for $100,000, my capital gain is $50,000. Same thing with stock. If I end up buying stock for $50,000 and I sell it for $100,000, same thing, same concept. I have a capital gain of $50,000. I'm just going to talk about capital gains as it pertains to stock, because real estate, as Kendra asked earlier in the chat, real estate actually has its own special rules and regulations. And if we start going down the real estate rabbit hole, we won't ever come out. Real estate's fun, but it has its special rules. And I always say, generally, you have to learn the rules of the game and you have to play them better than anyone else. And I've noticed a lot of us have gotten into stock market investing, real estate investing, and not understanding the rules. And then they don't understand why they get this nasty tax bill at the end of the year, like what happened. So, but anyway, so for capital gains, that's pretty much you're selling a capital asset at a profit. And then you also have royalty income, which is basically using you're selling something that you have intellectual property. There's some kind of intellectual property that you have, some kind of product that you're kind of leasing out to someone to use for their benefit. That's royalty income. Also, if you own land and there's minerals under the land, that's also when you lease that out, you're actually getting royalties from that. And I used to do that in my other life as an attorney. I was an oil and gas attorney, and we did a lot with royalties. So that's your 7 streams, and I just want to talk about that. So like I said, investing in the stock market provides 2 streams of passive income, dividends, and capital gains. So a lot of people don't understand the stock market because they don't understand how kind of stock even exists. So to kind of give you a background on that, there's 2 ways for a corporation to raise money. They can either sell a piece of itself, which is selling stock, or they can borrow money, which is basically issuing bonds. So you're either picking up equity, which is your stock, or you're borrowing money, which is debt. So there's 2 ways to do that. For example, Starbucks has a bond that's out that's doing, I think it expires in 2021. So that's the first thing. But it's paying like 2% every year. Now, we all know that 2% every year is actually better than some of these savings bonds that we're getting. But at the end of the year, at the end of 2021, you're getting periodic payments, and in Starbucks' case, you're getting a payment every 6 months. And then on top of that, in 2021, they're going to give you your money back. So, which is good, but there's nothing that you don't have an expectation that over time the value is going to increase. You just think that I'm going to get this regular payment, and at the end of the term, the end of this is being over, I'm going to get my money back. Same thing when you're like, think about that as when you're buying a car. You get a car for 60 months, you have a regular payment that you pay every month, and at the end of the term, you basically get the money, you get the car, you're owning the car. So it's a time period that you're paying for. You're saying, hey, you're loaning me this money, and they're saying, because you're loaning us this money, we're going to pay you a premium, but it's not going to be that much because interest rates are low. So where you actually get the value is in the stock. You either get the value from capital gains, and then you also get dividends. Now, I also want to say that dividends aren't necessarily something that's guaranteed. The board of directors make a decision as to whether to declare a dividend or not. And the board of directors, depending on a type of company, some companies will have dividends, some won't. Stereotypically, and as you know, the game has completely changed after 2008. After the stock market crashed in 2008, things have kind of been different than what we were used to in terms of being investors. But generally, with the stock market, you're going to have your dividends if they're declared. Your technology companies usually don't provide a dividend, but Apple has been providing a dividend. And we all know Apple's a technology company. So it just really depends on what's going on with the company. Dividends are basically the company giving away the money, their profits and their earnings to their shareholders, saying, hey, you're entitled to this, you own a piece of this, you're entitled to a piece of the profits, a piece of the earnings, so we're going to give it to you unless we have another place for those profits and earnings to go. And usually technology companies say, hey, we want to put this into what we call R&D, which is research and development. We have a place for this money to go. So as you can see, I talked about what is stock. So to kind of just talk about it again, it's that stock represents ownership in a corporation and represents a claim on part of the corporation's assets and the corporation's earnings. That's it. So basically, like I said, a shareholder is a part owner of a company. So as a part owner, you're entitled to vote at shareholders meetings. So you're voting for who's going to be serving as the board of directors. You're also entitled to profits and earnings, dividends. And then you also have a reasonable expectation that your investment will increase over time, which is your capital gains. So I want to talk about generally, because we talk about the market. The market is on the news all the time. They're like, the market did this, the market did that, the market. And people seem to, and the way it's presented on the news is that it's all of the stocks. But really the market, when they're referring to the market on the news, they're only talking about the Dow Jones Industrial Average. And the Dow Jones Industrial Average is only 30 stocks. That's it. But the reason why they kind of follow it as closely as they do is because they feel that the Dow Jones is indicative of the United States economy. And so, but there's some interesting things with the Dow Jones is that it's a price-weighted index. So basically, the higher price stocks have a greater influence on the value and the movement of the index. So you have like Boeing. So Boeing right now is the highest price stock. So if Boeing has a terrible day, there's a strong possibility that the market is going to be down because Boeing is such a highly priced stock, and it's going to move the index more so than I think what we'll say like I think Amex may be on the, I think American Express may be on there. I think they're like $70 a share. So again, these smaller companies are not going to move the index as much. So you see Boeing, Goldman Sachs, and I believe 3M is also on there. So generally, the stock market, the hours are 9:30 in the morning to 4 p.m., Monday through Friday, excluding the holidays. And it's just basically holidays. And there are certain times of the year where they will close early. Usually Black Friday, they'll close early. Sometimes Good Friday, I think Good Friday they're closed, or they may close early. Offhand, I can't remember. But there are certain times that they'll actually have a shortened or abbreviated trading day. Now there's two major exchanges, the New York Stock Exchange, which is, and the NASDAQ. There's also what we call the pink sheets. Now the interesting thing about, I put the the over-the-counter bulletin board sheets and the pink sheets, I put them on there because the bulletin board, the over-the-counter, the OTC, that's a part of NASDAQ. And I think it's really important to know that that's where penny stocks are held. Out of the two, penny stocks and the over-the-counter and the pink sheets, the over-the-counter market is more highly regarded. But what's usually hanging out in the pink sheets are something it's usually thinly traded. It's usually harder to get into. It's usually a stock that's been delisted off the New York Stock Exchange or the NASDAQ. Some of the important things to know is that the New York Stock Exchange and the NASDAQ have listing requirements. So you can't be your company. A company that's in good standing, a company there's nothing wrong with, is typically not going to end up on the pink sheets or as a penny stock unless there's something going on. So a lot of people, when they start getting into the stock market, they're like, oh, I'm going to get these penny stocks. I'm going to really get those. I can get a whole bunch of them and they're going to go up. Well, not necessarily. You could really lose everything you have, because that's kind of indication that something is wrong. I call it the manager special. It's like, oh my goodness, I'm getting this like top cut of steak, but you have to cook it that night. So again, you can get in, get out. Sometimes you can do well, and then sometimes you wait too long and then you end up losing everything, because a lot of times those companies tend to go bankrupt. And the disclosures are not as much as, say, what the disclosures required for the New York Stock Exchange or the NASDAQ. So there's a lot of things going on, because when you're a publicly traded company, the Securities and Exchange Commission requires that you do a lot of disclosures. You have to tell, basically, I like to say, tell all your business. And if you don't tell all of your business, then there's fines and penalties on it. So if everybody remembers Enron, part of the biggest thing that they did wrong is that they were falsifying documents. And that's really where a lot of them got into trouble. It's not that your company wasn't doing well. It's not that you were, it was the fact that you were concealing. It was the fact that you were changing your books. It was the fact that you were doing all of those things. And that's how you really get in trouble. So I really like to tell people, it's not necessarily that your company is doing poorly. It's the fact that you're not disclosing it to investors for them to make an educated decision. So the process. So now we're talking about buying stock, holding stock, and selling stock. So a lot of people, where they get stuck is what to buy. And then they also get stuck on where to buy it. So we're going to talk about that. And I'm actually going to walk you through a trade on Charles Schwab. I wanted to walk you through Ally because I like Ally's platform. It's a little bit more intuitive. It's a little bit easier to read, but unfortunately I didn't fund my account properly. So you can see the money that's in there, but it takes about 48 hours. And this is something for you to know also before you can actually do any trading. So I did the trade. I put the money in the account last night, but unfortunately it takes 48 hours. So it won't be available, I think, until tomorrow. So it just happens, but I have another account to show you to kind of walk you through a trade. So let's talk about what to buy. So buying stock, generally what I like to talk about with new investors is that I want you to come out the gate with good habits. New investors don't buy what they don't understand. And then some of the best stocks can be discovered by just paying attention to your surroundings. A lot of people will say like, oh, this new business opened up and it seems to be doing really well. Well, I suggest you just go to Google and see what's going on with it. See what makes this business so special. What's the hype about? What do they offer? Also, a lot of people were saying, hey, when iPhone Apple came out with the iPhone years ago, and I think it may be almost 10 years ago, when that started happening, it really changed the whole face of telecommunications. And if you know from back in the day, it was an exclusive contract with AT&T starting off. So you're saying, hey, well, what does that mean? You as an investor or a potential investor should say, well, what does that mean, that relationship between Apple and AT&T? And you should start looking at what that means for those companies and start following it. And I don't tell people, hey, you see something going on, then you automatically go buy. You just watch it for a little bit, do some research, find out as much as you possibly can. Google is completely your friend. I Google everything. And I Google things because not only will I find things like on CNN Money, or I'll find things that are on Forbes. I'll find things kind of in the Wall Street Journal. I'll find things that are searchable, but I'll also find kind of like other commentary from people who are watching it just like I am. And they'll say, hey, did you catch this thing? This is what I think this thing means. Now, they may be right or wrong, but it's at least giving some other commentary. It's pretty much like the gossip. So I follow the gossip of companies all the time, because if you really get into gossips, it's like gossip on companies or commentary about companies. It's pretty much like watching The Young and the Restless. It's pretty interesting. You're saying, okay, well, this company's merging with this company. The CEO is stepping down and he's going to this other company, or she's going to another company. The reason why they're not doing this, or they decided not to go this way, is this. But then you end up saying, well, and what I like to do is that if a company says we're not doing this product, we're not using this product, like for example, there was a company who went on Shark Tank, and offhand I don't remember the company's name, but they had a process that they sold, and they tried to get on Shark Tank, and all the sharks were like, no, we're not interested, and Amazon picked it up, and now they're like billionaires. So again, I like looking at those things, like what did you turn down as a company? And I like looking to see that, because if I see value in that, I may see if I can invest in it. Now, granted, that's kind of like what I call my speculative investments. I have my kind of core set, and then I have some that are kind of like my outdoor, like my kind of off the beaten path things. So, and I'm going to talk about some of the stocks that I personally invest in. That's not for me to say, hey, you should invest in these stocks, but it's just giving you an idea of kind of what I look for. So I tell people to make your own list of a company, of the things that you use, things that catch your eye, and the things that your kids bug you about. It's crazy about how, like, Cabbage Patch Kids, like when I was growing up, there's Nintendo was hot when I was growing up, and had my parents invested in the things that I thought were amazing and I thought were hot, we'd probably be millionaires now. It happens. But kids seem to be really in tune to what's going on, and kind of what's, I don't want to call it what's hot, but what's kind of innovative. So kids tend to be a little bit more in tune than we are. And sometimes it's just good to listen to see what they're talking about. Okay, so picking a company. So I talk about, these are companies that I use on a regular basis, just to kind of show you what's going on with me, like how I just kind of go about looking at companies. And I go about looking at companies, these are like kind of my standards. These are things that I use, things that I understand. I understand how the business works. And then I have things that are kind of off the beaten path, like cryptocurrency. I don't invest a whole bunch, but I invest something that I can lose. Like if I say, hey, I'm going to put in $300, I probably would have spent that somewhere else, but I feel comfortable. If I lost $300, I wouldn't be like, devastated. Like I wouldn't be able to make my rent, or I wouldn't be able to make my light bill. That's kind of what I don't do. I don't invest in things, period, that I'm basically foregoing paying for like a basic or a necessity to invest, with the hope that I'm going to get something back, because I don't do that. And I think a lot of people have kind of I've noticed that on social media. They're like, yeah, I'm going to take this money off my credit card, I'm going to flip it. Well, that's, and then I'm going to try to I'm going to try to pay off the credit card before it's done, before the end of the cycle. Well, sometimes it doesn't work out that way. So I tell people, if you can't afford to lose it at first, not to invest it. I mean, at least in the stock market. I try to tell people that. I know it's kind of like, sometimes I'm talking to people that don't want to hear that, but I really want you to be intelligent investors. I want you to be smart investors. So anyway, so we're going to talk about these companies. So I have my Starbucks. If you know me personally, I love Starbucks. And I love, not only do I like the coffee, because their coffee is super strong. I started drinking it in law school, and it's just, it keeps me awake. But I like their business philosophy. I like the way they treat the baristas. I like the fact that they want to educate the people that work for them, because they value an educated employee. So those are the things that I value. And that's why I think picking a stock is very personal to a certain extent, because I don't want to be involved in a company that they have values that I don't agree with. So that's my Starbucks. So Target, I shop at Target. I'm always at Target. Target has the best hours, and they have the most stuff. If I ever need to do something in a rush, I can always go to Target. I always can get something there. It's always clean. It's always comfortable. And I just like Target. So that's Target. Amazon. Amazon, I mean, I think everybody uses Amazon. Amazon Prime works really, really well. Okay. Let's see. I will answer that for you in a second about the books that I like. So also I like, let's see. So Netflix, Amazon, Sprint, Apple's, Miss Jessie and Coil by Nature is what I use in my hair. They're actually not publicly traded, so I couldn't purchase them. And then Sunoco, that's what I put in my car. And then Capital One, I just really like their whole suite of services. So the question that was asked of me is, what books do I recommend for a new investor? I love Peter Lynch's One Up on Wall Street. I think it's a very, very good book just to kind of just to emphasize the things that I talked about investing in what you know, investing and kind of paying attention to your surroundings. You may catch something that catches your eye, but it may not catch anybody else's eye, but it may be a good investment because you understand how the product works. One Up on Wall Street basically talks about saying, hey, you as an average investor, you can beat the analyst. And I think that's because I think people are like, oh no, picking stocks or looking at stocks is for somebody who has a finance degree or somebody like that, but they can't catch everything. And some of the things that you see as a consumer, they don't see as an analyst. So just never think that, I like the way it emphasizes that just because you're not an analyst doesn't mean that you can't do this and do this well. Fair enough. Also, The Intelligent Investor by Ben Graham. I think it's a really good book, but it's thick. It's like 600 pages, but I think it provides a really good background in terms of looking at stocks. But the Peter Lynch book's relatively quick. There's also a book that is called The Markets Don't Forget, But People Do, by Ken Fisher. And it just reminds us that the whole point of the book is just reminding us that the markets are cyclical and everybody's like, this is the worst thing that's ever happened to the market ever. And then like 3 years later, this is the worst thing that's ever happened to the market ever. So again, it's that people kind of have a very short-term memory when it comes to the market, but the market does follow some patterns. There are some kind of outlandish patterns that happen like 2008. But if you know anything about 2009 to current, we're in the longest bull market pretty much ever. So what I mean by bull market is a market that's trending upwards. I like to say when a bull, if you think about a bull market and a bear, so a bull has horns and horns go up. So if they're saying there's a bull market, think of horns going up, which means the market is going up. If they say a bear market, that means it's going down. And that if you think about a bear is like laying around, it's rolling around, it's on the ground. Think of the bear market that way. So bull's up, bear on the ground. So let's see. So I also talk about the importance of having a watch list. Like if we look at Amazon, I'll look at Amazon again. Just want to double check my time. Looking at Amazon again, it's $1,500 a share. It's for the average investor, it's basically impossible to get with Amazon on that level to say, okay, I'm going to buy 10 shares of Amazon. But so what I do is I tell people a couple things. One, I think it's super important to have a watch list because I purchased Amazon for $938 a share in August. And as you can see, it's now $1,500 a share. But if you were looking at Amazon over the time, Amazon kind of kept going up. It was going over 1,000, then it would drop below. It would go over 1,000 and drop below. But I was kind of looking at it and saying, okay, I think this is a good price for what we have going on here. I'm going to get in. And I did get in and it was a good price. And I'm not telling people to time the market, but I think it's also important for you to say, okay, if something's over your price point, just putting on your listing, okay, I like this company. I understand this company. I think this company is good, but it's a little bit too pricey. Keep it on your list. And sometimes, like when Donald Trump says something crazy, the market goes down, you may be able to get in at a price that makes more sense for you. So just think of it as your sale list. So again, if you see this jacket that you love in the store, you're like, oh, I love it, but it's full price. It's a little bit out of my budget. But as soon as you come back in the store, maybe a month or two later, then all of a sudden that jacket, same quality, same everything is on sale. So again, it's that same concept. So just think of it as your sale list. But I'm also saying all the stocks that I talk about, I'm not looking for you to buy them. They're just examples of things that kind of the process that I use to pick stocks. I don't want you going out and buying them. So we're going to place a trade. So let me see if I can just switch pages and see. All right. So I'm going to switch out of here for you and I'm going to share my screen on the stock side. Of course, it was up a second ago, so my apologies. So while I'm here, does anybody have any questions for me while we're doing this? Because I want to make sure that, like, as I'm talking, I think there's a lot of the things that I'm saying. And okay, so Kristen asked a really good question. She asked if crypto is worth investing. And then she was asking about mutual funds. And then in terms of stocks versus real estate, where to start first. Okay, those are really good questions. Thank you, Kristen. I think the biggest thing is looking at stocks and thinking about, I want to start with cryptocurrency. Cryptocurrency is pretty much like the hot thing for everyone. I think buying one coin that you honestly understand how that coin works is pretty much the best thing that you can do if you're interested in getting into it. But also, again, it's about purchasing a coin that you feel comfortable in, as opposed to picking something that everybody else seems to be talking about. I really think I cannot stress how important it is for you to understand the underlying technology behind the coin. I think that's the biggest thing about working with cryptocurrency, is that a lot of people so with Bitcoin, it's the whole point of Bitcoin is peer-to-peer. You're transacting money between two people, and you're trying to keep it the price or the cost of the transaction relatively low. And when you add this third party, like a PayPal or a MasterCard or whoever you're using, you're dramatically increasing the cost of the transaction. So the whole point of Bitcoin is removing that trusted third party, adding the blockchain or replacing it with the blockchain, which drastically decreases the cost of transaction. That's with Bitcoin. And then with Ethereum, you have the whole idea of smart contracts. And I mean, smart contracts has a lot more to it. It's not really a peer-to-peer transaction. It's a means to transact business without adding additional third parties. So again, and those are just two examples that I wanted to talk about, just so you understand. With crypto, I think it's super important that you understand the basics of the coin before you jump in. But if you want to just jump into one coin and see how that works, then that's fine. I just want you to not invest more than you can afford to lose. So you're saying, hey, I can only really afford personally to lose $50, and that's okay. Then only invest $50. A lot of people I know that were investing in December and November really ended up getting burned because of that big dip that happened in January. Now, if you're a regular cryptocurrency investor, you knew that that some investors pull their money out around January, around the new year. So it was a really interesting thing that a lot of people just didn't realize that was happening until it happened. And they're like, oh yeah, this does happen. So again, it's about understanding kind of the lay of the land. So let's see. We're going to share screen. All right. All right. So we are looking at my stock account, one of my stock accounts, and I'm doing this so you can see. So what I'm going to do is I'm going to go here to trade. Then we're looking to trade stocks. And if you can see, there's a lot of different things that you have available. So you have trade stocks, which is your market hours. So that's 9:30 to 4 o'clock. So if I'm going to put a trade in, which clearly it's after 4 o'clock, the trade's not going to execute until tomorrow morning at least after 9:30. Extended hours is not available to everyone. They like you to be a little bit more seasoned investors to have that available to you. But extended hours, basically you could have a trade execute directly right now, because there are people trading. It's just not, the market is not open. So think about it. If you've ever gone to Walmart during like a 24-hour Walmart, not everything is open at 11 o'clock at night. But you can purchase most things, but you know, it may not be as quick. It may not be everything that you want. You really can't find someone to help you, because they're kind of working with a skeleton crew. So those are the things that just think about that when you're talking about looking at after hours or extended hours. So I'm going to do Starbucks, because Starbucks is just as easy. So if you can see, you have the high for today. You also have the low for the day. And then you also can see some interesting things that I like to look at. I like to look at the 52-week high and the 52-week low. I like to be under that 52-week high because I feel like when we're starting to look closer, we're starting to get a little bit too close to the 52-week high. I feel like it's more likely that the stock will go down than it will go up. So I'll end up losing money off top. So the calculation that I like to use is kind of a percentage. So I'll say I usually like it to be about 75% or 80% of the 52-week high. And I think we might be actually over that. So just give me a second. Yeah, 80% of the 52-week high is $51. So we're actually above it. But that's pretty much I'm just going to show you how to do trade, because otherwise for me to find a trade that actually fits the criteria that I normally like for purchasing a stock, we'll be doing this all night. But so you have two options. You have an option of a market order, and you also have an option of a limit order. And when you have a market order, you're saying the next available price, that's what I want you to purchase it. That's it. If you're saying a limit order, they're going to ask you, well, how much do you want the limit to be in? So you want it to be out or below that price. So because I'm interested in purchasing stocks that are around 75% or 80% of the 52-week high, I'll say 51.89. And then I'm going to say here, so now I have I have other options that are available. So let's go back to market so you can see that under market, my only option is a day order. Okay, and Kristen wanted to know why I chose Charles Schwab instead of other online trading platforms. I chose Charles Schwab because that's the account that I have available. I have a Merrill Lynch account that I use. That's pretty much my predominant account that I use, but I'm actually moving to Ally, and because I didn't fund the Ally account in enough time, because I haven't moved everything over properly from Merrill Lynch to Ally, I couldn't use the Ally account because so that's the only reason why I use Charles Schwab. So I'm going to go into Ally account, but it's going to stop me at a point. But I just wanted you to see kind of how these things work. Most of the trading platforms are pretty much the same, but I think Ally works a little bit better. It's a little bit cleaner to look at, to Kristen's point. So I'm sorry. Okay, how do I get out of here? Okay. So here I'm going to review my order, and I tell people when you're putting these orders in, there's a couple things I want you to do. I'm going to review because they're going to tell you to review before you place your order. I want you to look a couple of things. I want you to look at the company. Are you purchasing the company you want to purchase, which is Starbucks? Are you purchasing the number of shares? I like to normally purchase in what we call a round lot, which is 100 shares. So that's what I did. It's just kind of like a habit. Sometimes I can't afford like what I have available in cash. I can't afford to buy a round lot, but I usually will buy what I can. I tell people to go to the market with a budget. Go to the market with a shopping list, and consider your commission fees as part of that. As part of the kind of the cost of doing business. So a lot of people are like, oh, my commission kind of put me over my budget. Well, you can't, because you're going with a budget. Don't allow the commission fee to put you over your budget. But as you can see, most of the time the commission fees are anywhere between Robinhood is $0, Stockpile is 99 cents, and then you have Charles Schwab, which is $4.95. Fidelity, I also believe, is $4.95. Ally is $4.95. So Merrill's $6.95, which is one of the reasons why I'm looking to move. Because it's just, I mean, I don't do a whole bunch of trading, but because I'm pretty much a buy and holder. But when I do my trades, if I know I can get something cheaper, why not? So, so as you can see, I'm placing an order for a day only, which means it will execute tomorrow morning at the next available time, which is a market order. So I'm going to place the order. So you're going to see that the order is received. You're going to see, I'm going to go to order status here. So as you can see, I did some selling out of this account because I'm moving this account, but I did do some selling. And as you can see, I just did most of them in market orders because I was just quickly trying to sell. Let's see. Any questions on trading? I'm going to try to see if I can pop into Ally. I don't know because it just may not happen. So let's see. Any other questions that you have so far? So I'm going to show you, let's see. So So what I'm going to show you is here, back to the PowerPoint. So to answer Kristen's kind of her question a little bit more in detail, picking a brokerage firm, you have your Ally, you have your Merrill Lynch, you have your E-Trade, Ameritrade, Capital One. Now I have a couple of asterisks, as you can see. First, E-Trade will give you a lower cost per trade. If you do 30 trades per month, you get $4.95. So basically, if you're a high volume trader, you get a lower cost per trade. But then also I have Capital One here because Capital One is was that side, the investing side of Capital One was purchased by E-Trade. So that transition is supposed to happen sometime in like second quarter 2018. It was done at the end of January, and they're starting to transition now, but the terms of when that full transition will happen is not very clear. So at some point, Capital One Investing, which is Share Builder, and just regular Capital One Investing will be E-Trade. Now, I really, really like Share Builder because you can buy fractional shares and you can kind of make periodic investments, which I think for a new investor is a really good idea. Because a lot of Ally, Merrill Lynch, E-Trade, and Ameritrade, they don't allow you to buy fractional shares. Now, with dividend reinvestment, when you're putting the dividends back into the stock, you can buy fractional shares, but normally you can't do that with, you can't just go out and buy a fractional share when you're working with these kind of what I call the traditional brokerage firms. So these right here are traditional, and then you have your apps, which are Robinhood and Stockpile. They're a lot less traditional, and their fees are going to be different. I really like Stockpile. I haven't really used Robinhood. I like Stockpile solely for purchasing for like kids that I'm not, like, they're not my children because I don't have any kids. But if I want to purchase a stock for a child, I'm not going to get the social security number and all that personal information for the child. The parent can set that up, but I can purchase a gift card to give to the parent, and they can do whatever trades they want, which I think is very user friendly. Now, like I said, there's three parts of the stock experience. When you're purchasing a stock, which we did, when we're holding a stock. So it's kind of like when you're holding the stock is good, bad, the good, unknown, and the bad. So the good is that you get money. So you get dividends, you have the availability to reinvest them. You get a 1099 div, which is a IRS form. So if you've ever been a contractor, you get a 1099. If you've ever done a rollover or taken money out of an IRA or any retirement account, you get a 1099-R. Those are the type of forms that you've received. So if you receive dividends, you get a 1099. In terms of the unknown of holding a stock, anything can happen. Like I said, I'm a buy and hold investor. And a couple of years ago, Sprint reorganized and they basically got rid of all my stock. I had 100 shares of Sprint. And I ended up, at the end of whatever reorganization, I ended up having a lot of cash, and then I ended up having like 30 shares. So I don't know what happened, and I don't even remember what happened, but it was like 2013 or 2012 that happened. And it was kind of like, what happened? How did this happen? But it was something that was done. It was something that the shareholders agreed to that I clearly wasn't paying any mind to. And that's something else while you're holding stock, is to pay attention to what's going on around the stock. A lot of people want to forget that, like, okay, I purchased the stock and I just want to forget it. No, you still got to keep up on what's going on, because you want to just make sure that what's going on with the stock is still in line with why you purchased it. And then you also have bad, like the drops in price. Like, again, you have kind of general market drops in price when the president decides he wants to go off the rails, and he wants to affect the stock, and whatever he says affects the stock market, like the trade war that started on Friday. But then you have that. But then also there's drops in price because there's bad press, or there's something that happens, particularly with earnings or expectations about a company's performance or what they're going to do, that will cause a price to drop. So then also I talk about selling stocks. So like I said, I'm a buy and holder. I have hold forever. I've had some stocks for about 13 years. So again, I've had them forever. I'm not getting rid of them anytime soon. But there are times that I will get out of position. If a company starts expanding their business in a direction that to me doesn't make sense as an investor, like if Krispy Kreme decided, hey, I'm going to start selling cars, I'm like, that's not going to work. So that doesn't work for me. If a company is showing signs of stress, like I don't know if anybody's been watching GE. GE at one point was like $30 a share, and now it's kind of hovering around 13, 14 a share. Part of that is because they cut their dividend. So the question is with GE is that is your company in distress? And if their company is in distress, and I did own GE last year, and I sold out about 25% as a profit, which to me was way lower than I've ever wanted to sell out, but I kind of had an idea that something was not quite right. But then also sometimes I get into a position where I'm just getting in, getting a profit, and I'm getting out. And then also with taxes, if you're not buying and selling at a retirement account, then you have your short-term capital gains. If it's less than a year, you're selling. And if it's longer than a year, then it's long-term capital gains, and it's no more than 20%. Most people pay about 15% on the gain. So again, so if I had that 50,000, let's bring back that $50,000 again. So at the most, I'll be paying 35% or so in taxes if I'm doing short-term capital gains. At the least I pay on long-term capital gains is about 10%. So it's a huge difference between if I'm deciding to hold a stock for less than a year or deciding to hold a stock for over a year. It's a huge difference in terms of, how much money do I get to keep? So I talk about that a lot. So sometimes people just want to jump out just to jump out. And if a company is not showing signs of stress, if a company is not expanding their business in a direction that doesn't make sense, you may not want to jump out so quickly to incur that unnecessary tax hit. Now, in terms of, there was another question that was asked about mutual funds. I really like to talk about mutual funds. I prefer mutual funds is a basket of stocks. If you're going to do something that's a basket of stocks, I prefer you to do an ETF, which is a exchange traded fund. They tend to be a lot cheaper in terms of kind of ongoing fees. And then you're not usually paying kind of this upfront cost. So with mutual funds, you have what's called a no load and a load fund. So a sales load is you'll pay about 5.75% upfront. So instead of putting $100 in, you're putting in something like $94 or something like that. So you end up putting $94. So off top, some of your investment is gone, or some of the money that you intended to invest in is gone. And then you also have some that are no load, which basically every quarter they're going to kind of charge you fees, which is going to eat away at your investment. And mutual fund fees tend to be higher. These ongoing fees tend to be significantly higher than ETFs, but it also depends on the type of ETF. If I'm going to look at an ETF versus a mutual fund, I'm going to look at an index fund, as opposed to kind of more niche-y or kind of more focused funds. Like some people will say, well, I want to do some value investing or some dividend investing. I try not to get into those with mutual funds or ETFs, because that means that I'm relying on somebody's thought, like their brain trust, and I'm going to pay for that. So I'd rather just do a regular S&P 500 index, a regular Dow Jones index, something like that. That's very simple. That's kind of following an index. They don't really have to do anything. A computer can basically run the strategy, as opposed to me using people to kind of get the results that I want, because again, I'm going to end up paying more. And over time, fees can erode at your investment pretty significantly. In terms of stocks versus real estate, it's pretty much whatever you feel comfortable with. I like stocks because I can start off the bat getting somebody investing with as little as $25. With real estate, you need a little bit more of initial investment. But either way, it's whatever you feel more comfortable. I like, especially for people of color, I prefer them to be in stocks to start. And the reason being is that when I start working with people that are high net worth, in terms of like people with African Americans, I also notice they're overweighted, what we call overweighted in real estate. When we talk about diversification, you want to be diversified, and not just stocks. Like having a whole bunch of stocks is not diversification. Having stocks, having real estate, having currencies, either it's foreign currency through Forex, or having currencies in terms of cryptocurrency is also another type of investment. Also having bonds, that's diversification. And what happens is you want to have kind of a pretty good weighting in all of those classes as you become a more mature investor. But a lot of times people will say like, oh, I have 90% of my portfolio in real estate. Now with real estate, it's not very problematic, but it is kind of hard to get out of. It's not what I would call illiquid, but it's hard. Like if I say I want to buy, if I'm going to sell that Starbucks stock, if it's during market hours, I can pretty much sell it, get out of it, and then that money's available in 2 days, in 2 business days. It's T+2. With real estate, you know, unless you're doing an all cash deal, it could take about 30 days. It could take a lot longer. Again, it's not saying that it's illiquid, but I like to have my money available a little bit quicker because I'm just that person. But also I am a real estate tax attorney. So there's a lot of things that I do in real estate. And with real estate, you have the ability to do a 1031 exchange, which basically means you can kind of do this tax deferred growth of your real estate proceeds. And basically you can do that indefinitely. So there's a lot of different things that you can do in each space that I think is beneficial for the purposes of wealth creation, wealth retention, and then also generational wealth. So it just depends on what you're comfortable with doing. Any other questions at all? So, okay, so let's see. So Kenny, you've asked about so Larry asked about Forex. No, Larry, I don't have any experience in Forex at all. I do every so often when something goes on in the world, I will kind of look to, I'll look to the Japanese yen, but there's some ETFs that kind of mimic Forex, but not as much as it's not as closely as I would like. So I have looked into Forex. I think that there's some value there, but again, I use that pretty much as like, if someone said like, where would you be heavily weighted? I'm heavily weighted in stocks, heavily weighted in real estate, cryptocurrencies, currencies in general are going to be less so. They'll probably be like maybe about 15 to 20% of my portfolio. I don't really like having so much cryptocurrency or currencies in general because there's a lot that goes into them more so than they're very political. Cryptocurrency says they're apolitical, but just the fact that it exists outside of the political structure means it's political. So the question about buying a IPO. If you can get in at the IPO, if you can get at the IPO investment at that point, and what I mean by at the IPO investment at that point is before it actually hits the market. If you get it when it hits the market, you can get in and make you can get in and make money with IPOs. I purchased a couple of years ago Gigamod, and I also purchased Textora. Textora was a Brazilian construction company, and I purchased that because I followed it. And with IPOs, you have to be very, very careful. They do provide a lot of disclosures, but remember, they don't have that much history. So you don't really know how the market's going to react to this particular holding. So I look into it. I really scrub the numbers. If you follow me at all, I did talk about Snapchat and how I wasn't purchasing Snapchat. And I was correct because their numbers just didn't make sense. Like it didn't look right. It didn't smell right. So it just depends on if you understand the company, what it's trying to do. If you see that there's a value there, you can invest. But I tell you, if you're going to invest, I would usually invest like the day of, like at 9 o'clock, like as soon as it hits. Like I think Snapchat hit at 11 o'clock on a Thursday. Like if you get in 11, like 05, okay, you probably did make money. But if you kind of waited a little bit longer after the hype died, the gains are not that clear. And like I said, I knew Snapchat was not a good look when I first went into it. And I usually run a class about looking at IPOs and really digging into the numbers and really digging into the commentary because you really end up finding stuff that just doesn't make sense sometimes. Kenny also asked about a bull market. And a bull market, since we've been in a bull market for so long, we're in an extended bull. Would it be worth waiting for a bear to start buying stocks? Well, you know, I think there's money to be made in any market. And I think that's very, very, I have to make that, I can't overemphasize that particular point. I want you to, that's why I really think it's important about looking at stocks that are under their 52-week mark. And significantly under their 52-week mark, because I want stocks that are not kind of still high, like hovering around that top point. Because again, always my concern is going to be it's more likely it's going to come down than it is going to go up. unless it's something that there's something coming out that's going to kind of like push it through its 52-week high. Like if this was Disney a couple of weeks ago before Black Panther came out, I would say, okay, well, they're having Black Panther. There's a lot of hype around it. You might, and it's around the 52-week mark. You might want to jump in if you want to. So it depends on what's going on. That's why I tell people you have to educate. You're like a good investor is a nosy investor. So it's not just looking at the price, but understanding everything that's going around in the price, or that's kind of contributing to the price. So that's pretty much all that I have to offer. Does anybody have any other questions for me? So, all right, well, see if we can get back to, let's see. I can just find my platform. So thank you. Thank you so much for having me. If you have any questions, you can find me on Instagram, the Ivy Investor. You can find me on Facebook. I will be running another masterclass on cryptocurrency, and I also be running another masterclass, a full masterclass on IPOs and how to look at IPOs and kind of look for the funky things that I look for. And again, like I said, thank you for having me, and I will see you all soon.
Courtney, thank you so much for coming on. So everyone else, let me